With just a few days left in the first quarter of 2022, some analysts are beginning to realize Tesla's massive potential within their forecasts. Just this week, Elon Musk officially opened up Tesla's brand new factory in Germany, Giga Berlin, and delivered the first 30 Model Y production vehicles to customers, a tradition that Tesla has kept with each of its Gigafactories. During Elon Musk's Giga Berlin opening comments, he stated that Tesla has been growing by 70 or 80% a year on average, and maybe even faster than that in the future. Tesla, of course, did witness 87% growth in electric vehicle deliveries last year in 2021, which flowed through the income statement, causing net income to skyrocket by a factor of 8 times over 2020's results, as Tesla earned over $5 billion in 2021 on sales of 936,000 cars. But more importantly, Tesla is now focusing on scaling to extreme size, according to Elon Musk, and his plans to develop the third part of his master plan to grow the company. In the most recent conference call, Elon Musk talked about bringing that to the forefront this year by not launching any new products which would actually slow Tesla down, and instead work solely on scaling components such as batteries, among other things, which are forecasted to be under high constraints for the years to come. While semiconductor chips are in short supply today, batteries will soon once again become the limiting factor. Tesla is laying the groundwork today and throughout 2022 to truly transition the world to sustainable energy, which inevitably means a drastic boost in EVs and battery storage systems, both of which will be produced at the new Giga Berlin factory. Now, bullish Tesla analyst Trip Chowdhry originally spoke about Tesla back in 2018 when he debated Tesla perma-bear Gordon Johnson and even compared Tesla to Amazon, saying that if the market followed Gordon Johnson's logic, then Amazon shares would have stayed at $2 per share and never recovered. At the time when he said this, Tesla stock was at $342 pre-split, with the market and even CNBC wondering if there was still room to run. Since then, the stock has risen over 14 times to $5,000 per share, taking into consideration that Tesla has undergone a 5-to-1 stock split. Despite this miraculous run-up since 2018 that Chowdhry accurately called, he now continues to pound the table on Tesla, citing that he is seeing monstrous demand for Tesla's products. He says that customers don't want to buy just an EV, they only want Tesla. And he goes on in his research note to compare Tesla to Apple, saying that it's an experiential product. No other company has the capability to create experiences like Tesla can, he states. While this is likely the case and Tesla is seeing record levels of demand, the more important part of the equation is production, because Tesla will be able to sell every vehicle they make for quite some time. This may also be true for other automakers as well. However, Tesla has been preparing for scaling its production long before many of the legacy automakers even got into the EV business. Other OEMs will therefore be highly constrained not only in chips like the industry is, but mainly on batteries. Tesla, on the other hand, has already signed contracts with major material and battery manufacturers and is currently rolling out their 4680 battery production hardware into Giga, Texas, and also ramping up in Fremont. As a matter of fact, we just learned on March 23rd that LG Energy Solutions will be building a $1.4 billion battery facility to help meet demand from EV makers, including Tesla. Tesla has also partnered with Panasonic and CATL. These are the largest battery manufacturers on Earth, and Tesla is working with all of them already and maxing them all out. This means that legacy automakers or new startups in the EV space will need to work with these players to build new factories, which could take many years to come online. And in addition to that, their volumes are so low today, which may be a small advantage in that it's easier to get battery supply right now. But because of low volumes, it's harder for them to forecast how many batteries they will need, since their vehicle production essentially needs to match their battery purchases. For instance, they don't want to risk buying too many batteries and then not having enough demand for their products. Conversely, Tesla is extremely confident with their future demand levels that it told all of its suppliers that they will buy every single battery that they make, and in addition to that, Tesla is making its own 4680 cells since they know that they will sell every car that they make, and even this level of batteries won't be enough for many years to come. Trip Chowdhry also backs up this claim for Tesla's monstrous demand, which effectively allows them to scale battery production to new levels, by saying that car rental company Hertz is adding Model Ys to their fleet, which is another positive sign given that Hertz alone is planning to order over 100,000 Teslas. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Trip Chowdhry also jokingly notes that Elon Musk did his magical dance at the Gigafactory Shanghai in January 2020 when the stock was at $115 per share. And Elon did the same dance at Giga Berlin on March 22, 2022, which has Trip wondering if the stock can 10x again. He does say that more Gigafactories creates a step up in Tesla's business and that Tesla's stock price is a function of the number of Gigafactories. Now, I don't think this latter point is completely true. Adding more Gigafactories is of course highly important. If each new Gigafactory has a capacity of 500,000 vehicles or more, then adding 2 new Gigafactories, Berlin and Texas, should double Tesla's output. However, Gigafactories have actually gotten significantly better over time, and so they don't exactly scale linearly. For instance, the Fremont factory, which assembles vehicles, relies on Giga Nevada for its 2170 battery cells. These are 2 separate facilities in 2 different locations, not to mention that Fremont is sort of a patchwork factory as Tesla built it up over time, starting with a building that was purchased from an old GM-Toyota joint venture. If we look at Giga Shanghai in China, the factory was designed and built from the ground up and already outpaces Fremont in terms of production at a run rate that may actually exceed 800,000 vehicles per year already, even as it continues to expand. The new factories in Berlin and Austin will also be combining vehicle assembly and battery production into the same facility, which already makes it significantly more streamlined than Fremont and Giga Nevada. And so going back to Trip Chowdhry's point that the stock price is a function of gigafactories may not be exactly true. If each gigafactory can scale to much greater levels on their own, then the number of gigafactories no longer matters compared to essentially the quality of the gigafactory. That may be an underestimated piece of Tesla's valuation. Chowdhry does currently sport a bullish $1,500 price target on the stock. It's interesting to note that with a continued 50% plus growth rate, as Elon Musk has said in the past, or 80% plus growth, as he recently said at Giga Berlin, Tesla could double in size every few years until they reach their goal of 20 million EVs per year. Looking at vehicles alone and ignoring other things like energy, solar, full self-driving, insurance, or Tesla bots, Tesla could still multiply itself by 10 times, as Trip Chowdhry suggests, since they're planning to get vehicle deliveries up by 20 times from under 1 million last year in 2021 to 20 million in 2030. Even if vehicle prices drop by half in order to hit this vast market, such as with a $20,000 or $25,000 vehicle, which would have the same margin percentage, but Tesla would need to sell more cars just to make as much money as the vehicles being sold today, Tesla's vehicle hardware business itself seems to still have plenty of room to run. In this same context, it's also important to look at Tesla's energy side of the business, which we've highlighted in the past will also see significant growth as battery production increases. Tesla is building a mega factory for megapacks in the United States, which could bring in billions more dollars for the company, and as mentioned, they're also going to be producing storage products in Berlin. Morgan Stanley analyst Adam Jonas says in his research note that Tesla is uniquely positioned to accelerate necessary re-architecting of the US grid. Of course, this can be extrapolated to other grids around the world as well. Tesla has already done some great work in Australia, for example, and continues to expand their storage systems worldwide. But again, the energy storage segment of the business seems to be highly overlooked. Investors keep waiting to see some growth here, but each year energy has been fairly disappointing, such that investors have stopped getting their hopes up and all but given up on this segment's growth potential. However, Tesla's vehicle demand has put them under such pressure that it makes a lot of sense to divert the batteries and resources towards vehicles rather than storage. It seems that just as some investors are losing hope on this division, there will be a tipping point when Tesla can finally satisfy battery requirements for vehicles and then flow the excess into storage. Given that this is the year where Tesla is focusing on scale, specifically battery scale, energy could actually finally get a boost sometime this year. Elon Musk believes that energy could eventually be as large as vehicles, given the worldwide demand, and so the market is there. And again, Tesla's stock price isn't exactly a function of the number of Gigafactories, if some Gigafactories produce storage systems, or if there are separate megafactories that produce storage systems as well. That could ultimately turn batteries into another massive business that rival the vehicle business in terms of size, but rather complements it. Nevertheless, most analysts are still highly focused on car deliveries. Wedbush analyst Dan Ives believes that Tesla's sales in China and Europe are 15% ahead of Wall Street estimates. And currently, the European deliveries are coming from Tesla's China facility, but now with Giga Berlin ramping up, Tesla will slowly phase out the shipments coming from China in favor of the locally built models. Wall Street currently expects 312,000 deliveries for the first quarter, which is actually ahead of the gigantic 308,000 December quarter deliveries last year, for which Tesla set new records. And Wall Street also sees slightly under 1.5 million deliveries for the year. Of course, depending on supply constraints and global shortages and anything else that could go wrong, these numbers can change. But Elon Musk hinted that Tesla could grow faster than 70 to 80%. Dan Ives suggests that Tesla could be on a 2 million unit run rate exiting 2022. Now, this actually isn't saying too much, since Tesla exited 2021 with a 1.2 million vehicle run rate. It's not their yearly volume, it's simply calculated by taking the final quarter of the year and multiplying it by 4. We also don't know exactly what Tesla's weekly run rate was exiting last year, which may help to push the upcoming quarterly numbers even higher, but they need to sustain a stable rate of production for it to translate into higher yearly volume. But what we do know is that by taking a step back and looking at the capacity of each factory by the end of the year, it's possible that Fremont, which has been far below its capacity, can perhaps return to its 500,000 rate, and maybe even more since Elon has mentioned that they are continuing to expand here. The Shanghai factory seems like it could grow at 1 million units by the end of the year, and Giga Berlin and Texas are set to have a 500,000 unit capacity for Model Y and perhaps Model 3. While it will still take time for these new factories to ramp up, Elon Musk has hinted in the past that these new factories may ramp up faster than their previous counterparts. If they can get near their 500,000 capacity by the end of the year, Tesla may be closer to a 2.5 million unit run rate by the end of December, especially if this is the year of extreme scaling thanks to monstrous demand. So do you think that these analysts are being too bullish with estimates for 2022 deliveries and price targets that are far ahead of Wall Street consensus? Is that unnecessarily raising expectations on Tesla shareholders? And do you think that 2022 is the year of Tesla energy, or will it still take multiple more years for energy to finally take off? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.